So strike price is a set price at which a derivative contract can be bought or sold when exercised. So for calls, the strike price is where the security can be bought by the option holder or the buyer. So for option seller, the strike price is the price with which you can sell. So you have the option to hold or option to sell. So for example, I've taken a previous example actually. So like let's say Nifty at 14,485. So different strike prices which are there, and they are called in the money, at the money, and out of the money. So let's have a look. So Nifty at 14,485. So if you're talking about call, this side is the call and right side is the put. Left side is the call, right side is the put. So if you're talking about call, if the strike price is lesser than the current market price, I repeat again, if the strike price is lesser than the current market price, the first strike price, which is lesser than the current market price, it is called at the money. So this is at the money. So 14,485. So 14,450 is your at the money for the call. So if the market goes beyond, so here if you look at the NSE website, the prices comes below, the higher prices are below. So anything beyond this will be termed as out of the money. Out of the money, you don't have any eccentric value. I'll explain eccentric value more a little later. Below this, it's all in the money. In the money means you have eccentric value in it plus also a bit of time period, right? So these are the strike prices. So when we are talking about strike price, current market price is Nifty at 4485. What is your at the money call? It is 450, 14,450. Similarly for put, remember it's the reverse. So you make money when the market moves down, right? So for put, at the money is, if it's 14,485, it will be one strike price above the current market price. So here it was below. For the calls, it's below. For the put, it's above. So 14,500 is your at the money call for Nifty, right? So as you go up further, so these becomes in the money because they have two things in it, the eccentric value as well as the time premium, which we'll get to see again. And out of the money, they don't have any eccentric value. So if the options expire at the current market price, all these option prices will become zero. So that's the puts at the money, in the money, and out of the money, and the call at the money, in the money, and out of the money. The best part is you don't have to put much head into it if you get confused. NSE does the work for you. So if you look at this, current market price of Nifty is 14,894. So it only recognizes in the money and out of the money. So all the shades which are darker are all in the money options. So you can see here the different strike prices. And as we said, left side is the call and the right side are the puts. All these shades which you can see, they are all in the money. And everything which are not shaded, they are all out of the money for calls. In the puts, in the money are a darker shaded, and out of the money are all lighter shades. Now, generally in practice, as traders, though we have the strike price moving up every 50 rupees, but most of the volume lies in the 100 units. So it's 14,900, 14,800, 14,700. So these strike prices have most of the volumes and the activity. So of course you can trade in the 950 as well, but I mean, we prefer trading 100 points ahead or behind.